Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, October 25th, 2017. I wanted to do an update on the U.S. equity markets. In fact, this video update will be quick because I'll only focus on the U.S. equity markets. Won't cover sectors, commodities, at least not in this video. I wanted to make mention that as of today, barring a sharp reversal into the close and a strong green close, I think it's safe to say that we have the probably about the highest probability sell signal or indication that the U.S. equity markets have just peaked. And I'm talking a correction peak. We'll see how far it goes from there. I'm not talking. This doesn't have to be the end of the super bull market, but it's certainly for the first time in many months, I'm seeing about as good a sell signals as I've seen in a long time. A lot is factored into that analysis. I've covered on the site some of my low volume indicators when volume levels reach certain extreme lows. You'll see. And I use an exponential moving average on the volume. We've hit those levels on IWM, SPY QQQ, so those are there. We have the divergences that have been forming and most recently have been now confirmed. So now we have the confirmed negative divergence. But in the recent days here, I've focused on some candlestick, bearish candlestick developments. It started out on Monday. We had on both the large cap SPY and QQQ, we had bearish engulfing candlesticks. And then I mentioned that I like to see those followed by confirmation with additional downside in the coming days. Now, yesterday was interesting. We didn't close. We closed slightly positive in both SPY and QQQ. However, we had those candles printed. These were inside days. An inside day is when the trading on any given day is completely within the range enveloped within the range of the previous day's candles. That's an inside day. You can see this candle is contained within inside that bearish engulfing candle, which then previously engulfed the body of the other candle. So not only was it an inside day, there's also a term for the candle, and that's a bearish harami. This shows basically what you have when you have a candle, again, within there, the smaller body, as it says, a bearish harami is a trend indicated by a large candlestick, which would be our bearish engulfing the other day, followed by a much smaller candlestick that's body is located within the vertical range. So it's almost like a bearish engulfing in reverse, if you will. And anyways, it's an indication. They said it's, here it reads, it's thought to be a strong sign that the trend is ending when a large white candle is followed by a small black candle. I have green and red colors on mine, but either way, that's what we're looking at. And so, although we didn't print a red candle, again, we closed slightly positive, but it was also a bearish candle. Now we have a red candle today. The SPY's down about 0.5%. Nothing crazy at this point. Again, we're just off the recent highs. So yes, very early to call a peak or at least evidence of a pullback. But this is it. These are the charts. Let's look at QQQ real quick. Show you that. You can also see there you can see the body engulfed here. The body, at least on that candle, was within the bearish engulfing from QQQ the other day. As of now, we're trading down. So there's the bearish crossover on the PPO that I mentioned. Again, this board doesn't have all my lines. And I'm going to say this: there is the potential for some big earnings that are coming up on, what is it, Thursday? Let me check my calendar after the close on Thursday. Keep in mind that we have several of the FANG stocks, 3 of the 5, in fact, FAAMG. Those stocks are reporting. We have Amazon, Microsoft, and Alphabet all scheduled to report after the close on Thursday. So I can tell you this, strap in, hold on. We're going to probably almost certainly see some movement on Friday. But regardless of the market's initial reaction, I always say that, doesn't matter what they report, how bullish, how bearish it is, what their guidance looks like, what the market's reaction is. So we're not going to really know. You'll get an idea after the close on Thursday, but you'll want to see how the markets trade and close on Friday and then follow through next week. Remember, the initial reaction to earnings is very often faded on a lot of stocks, whether they gap up and it's faded. Or they gap down and then that gap gets bought up. So again, I don't react to initial reactions on earnings. I let the dust settle. I just want to throw that in there. But so there's a possibility that some blowout earnings or bullishness following their earnings reports on some of those leading market leading stocks. We also have Intel reporting that day as well on Thursday after the bell. So like I said, anything can happen, but if you sit there and second guess things all day long, you're going to have paralysis from analysis. Right now, priced into the charts is again as good as I've seen in a while. Says we're going to have at least a pullback here. You probably ask me, well, where are we going to go if we do pull back? These would be my targets, same ones I've focused on for a while. We have a primary uptrend line here in SPY. That's certainly a logical place to bounce. I had an alternative trend line here, but we've already sliced through it. So if I could ignore it or not ignore it, either way, they come in roughly together. So maybe a little bit here if we pull back. It's about, call it, if it happens in the next day or two or by Friday, about a 1.75% lower. Then, and I do favor a move down at minimum to here. That's 248.27. You can see the levels marked. Um, and being that we would break that trend line, looking at the negative divergences and everything else factored into this market now, at minimum, I'm looking for, before all is said and done, a pullback here to 232.50. That's about a 10% drop in the markets. Again, you decide, if you're longer term bullish and you think they're going to just buy up any pullback, these are support levels. That's what I think where my strength lies is identifying significant support levels that are very likely to produce a reaction when hit. So therefore, if you're a dip buyer, sure, you want to buy the first dip, 248.27, give or take. I wouldn't try to get it to the penny, step in a little early. And if you're a short seller and you want to go short the markets, these are the levels. And if you want to game the bounces, in other words, if you're an active, nimble trader, and again, there's more that goes into it than just saying, okay, every level we're going to have a bounce. You look at the intraday charts, the 15-minute charts, the 5-minute charts, the 60-minute charts, but all other things being equal from what I'm looking at now, that's what I see. And this is my if things get ugly target, 219.63, and that would represent a drop of about from where we are today. That would be about a 14% drop if we get there. If we hit my 232.50 target, you're talking about a 9% drop from where we're at, which is roughly, 10% off the highs. And that's that's the minimum definition of a correction, technically speaking. Most people use a 10% drop, whereas a bear market is a drop of 20% or more. So that's that. And QQQ, the targets, I don't have them marked as clear. But you can see here, each of these lines are support levels, and I have the 136 level marked because that's I'll just call it my preferred swing target. So again, that's about an 8% drop. So barring some, crazy bullish price action following Amazon, Microsoft, and Alphabet reporting on Thursday, as well as Intel. Intel is also one of the top 10 components, so that one's certainly worth mentioning. That's where I think we're going in the coming weeks to months. So trade it as you want. You can look at the small caps as well. Small caps have been very strong recently, but they just put in a big divergent high, extreme overbought. These are levels I think will come back down. If that scenario in the large caps play out, we're probably coming down at least to that bottom of the range that defined trading, that contained all the pullbacks in IWM going back to October. It was a year ago, October of 2016 or so, somewhere around there. This trading range down at 130, 345, and that's about a 10% drop. So um, those are some pullback targets for swing traders. And again, the charts are dynamic, and so is my analysis. So if something happens today and we get a crazy reversal, I mean we're down 0.82% right now. Again, nothing big to write home about, but coming from this recent range of tight uh, very low volatility, how the market walked up. And I mentioned in my video yesterday, and I've mentioned it recently, it only takes a few down days. This market's like a powder keg right now. The short interest, I've checked it across the board on a lot of stocks on the index, extreme lows, coupled with low volume. We all know that the institutions have just been loading up, going long. There's a lot of buyers in here, and because the short interest is low, That means we know there's not you don't have the usual shorts to step in and cover. And where I'm going with this is you get a rush for the exits. If the institutions decide, hey, we need to reduce our exposure, market looks like it's going to correct, it's very hard to exit in a low volume market. You know, those big institutions, especially if they all do it at once. So, as I said, the I can see it in the charts. The potential is there for one of those swift, you know, waterfall sell-offs that will wipe out. In this case, as I went over recently, here's going back to what was that, September 11th. That's what I'm looking at. If that first target's hit, and that will have wiped out, all the gains for the last couple month or so here. Almost 2 months of gains, and it can happen in just days. So um, that's my analysis. Let's leave it there. We're just over the 10-minute mark, and good luck to everyone. This has been Randy Finney with the right side of the chart. Hope